Apple reportedly went to great lengths in order to avoid tariffs imposed by President Donald Trump. According to a Reuters report, the tech giant chartered cargo flights to ferry 600 tons, or 1.5 million iPhones, to the US from India. A separate report in the Times of India stated that Apple transported 5 planes full of iPhones and other products in just 3 days during the final week of March. As per the report, the company quickly moved inventory from manufacturing centers in India and China to the US in order to avoid a new 10% reciprocal tariff. This pre-tariff stockpiling has helped Apple maintain steady pricing for now.
iPhone prices could skyrocket. Here's why you should care. iPhone prices could soon leap from $1,599 to $2,300. Why? Because Apple just airlifted over 600 tons of iPhones from India to the US in a desperate bid to sidestep a new wave of crushing tariffs. The real question now: can Apple escape the taxman without Americans footing the bill? In an unprecedented move, Apple has begun rerouting its global supply chain, with entire cargo planes loaded with around 1.5 million iPhones. This is no test run. It's a calculated shift in strategy. Faced with U.S. tariffs as high as 125% on electronics from China, Apple is shifting gears. Where China once stood as a tech giant's assembly base, India is now stepping up. Why India? It's cheaper, politically safer, and not currently in Washington's tariff crosshairs. The result: Apple is betting big on India as its future production hub. But will it work? Even with the shift, prices won't remain stable. Building an entirely new supply chain, training a fresh workforce, and investing in infrastructure isn't cheap. And let's not forget, airlifting phones halfway across the globe costs a fortune. According to analysts, if the iPhone 16 Pro Max were still built in China, the price tag could rise to $2,300. That's a $700 surge. But even made-in-India models will carry extra costs due to logistics, inefficiencies, and startup friction. Bottom line, U.S. consumers will feel this directly. Tariffs may not appear on receipt, but they'll show up in the final price. This is more than just a shift in manufacturing. It's a global restructuring. Apple isn't just tweaking its process, it's changing the game. And other tech giants are watching. If Apple can pull this off, others may follow. But India is not China, at least not yet. Infrastructure gaps, logistics hurdles, and high capital costs are real. Plus, those 600 tons of iPhones? That airlift was a band-aid, not a long-term fix. Still, Apple has made its move, and the ripple effects are massive. U.S. markets are already reacting. In the past 48 hours alone, the Dow Jones plunged over 1,700 points. Major players like Qualcomm and Tesla are also feeling the squeeze.
Wall Street's main indexes ended higher on Monday, with the Dow and S&P 500 each gaining about 0.8%, and the Nasdaq climbing more than 0.6%. Shares of Apple provided a boost after the Trump administration removed smartphones and other electronics from its tariffs on China over the weekend. Shana Orsic-Sissel, founder and CEO of Bonrian Capital Management, said the iPhone maker is one of several tech companies she remains bullish about amid the recent market volatility.
For me as an investor, I'm looking at this market and I'm excited. You're never going to be able to pick the bottom. But what you do want to focus on are the names that you really liked before, trading much cheaper than they were and taking advantage of those opportunities. That may mean buying some today, and then if it goes down further, increasing that position. And for me, those are names like NVIDIA, Apple, Vertiv, Leidos.
U.S. companies have begun to report first-quarter results, and with tariff troubles looming, corporate executives may hold back on giving much guidance.
As China retaliates with 34% tariffs on $143 billion worth of U.S. goods, including agriculture, the trade war escalates. Farmers, already struggling, are getting hit again. The U.S. economy is now facing a projected 0.5% GDP drop, and 500,000 export-based jobs are on the line.
The Nasdaq is the worst performer among the major averages right now, and two of the hardest hit tech stocks Apple and Amazon sinking. Apple on track for its worst day here since 2020. For Apple, tariffs posing huge hurdles for the future of iPhone production as well as its global supply chain. Joining us now to talk about all this, Tom Forte, Managing Director and Senior Consumer Internet Analyst at Maxon Group. Tom, it is good to see you. Let's start right there, Tom, with Apple. I'm looking here. We're down almost 10% here, Tom. What do you make of that move? Is that move justified, Tom?
Yeah, so I think it is. If you look at the recent performance of Apple's stock, it's rare for it to have that kind of outsized move. I think that investors today have been hyper-focused on tariffs to the extent that, if you're like Apple and you have a global supply chain, it is going to pose challenges. And I think, though, stepping back, Tim Cook and Elon Musk, I would say, are the two best CEOs at managing, ultimately, government relations with the United States and China. And I think that what President Trump is clearly trying to do is to adjust the trade deficit and bring back manufacturing to the U.S. So I think the good news for Apple, I guess, and I would say the argument for 10% down being too much, is that it does have pricing power. So it may not be able to completely mitigate the impact of tariffs, but it can raise prices. And then historically, it focuses on the higher margin consumer electronics and generates a ton of free cash flow. And the good news is at some point you would imagine that the Trump tax cuts could become permanent and then Apple would just buy back more stock. So long-winded way of saying I think down 10 is too much of a negative reaction today.
Across the Atlantic, the European Union is also stepping up. In April 2025, Trump slapped 20% tariffs on all EU goods, calling them bloodsuckers. The EU hit back, not with cars or wine, but with a data war. Big tech got blindsided. Meta, Apple, and Google together earn over $250 billion from Europe annually. The EU didn't fire missiles. It fired legislation, GDPR updates, digital taxes, anti-coercion measures. The message: our data, our rules. Google had to reveal its algorithm. Meta might soon be required to share emotional data with competitors. Amazon can't export warehouse intelligence. Big tech now plays by Brussels' rulebook, not Washington's. Then came the taxes. A 3% levy on total revenue from digital sales, profit or no profit. Europe didn't just strike. They targeted America's economic nerve, digital dominance. The EU also launched their ACI anti-coercion instrument, blocking U.S. companies from bidding on certain deals and locking patents behind red tape. It's a quiet economic siege, fought with clauses and compliance instead of bombs. And what about Canada? The U.S.'s closest neighbor is pulling away fast. After Trump's remarks and tariff threats, 90% of Canadians support severing trade ties with the U.S. Canada quickly signed new deals with Europe and pivoted trade to Asia. Provinces like British Columbia banned U.S. agricultural imports, while Quebec froze contracts with American companies. McDonald's, Starbucks, and Apple began disappearing from public systems. Public agencies are now required to buy local, enforced by direct subsidies. In April 2025, Canada held a surprise general election. New Prime Minister Mark Carney took the reins and declared, Canada will never be America's sidekick. Opposition leaders echoed this message. Even Trump-aligned figures rejected the idea of union with the U.S. In a bold cultural shift, American flags were turned away, anthems booed at public events. This wasn't just policy, it became a national movement. And just when you think the storm has passed, Trump throws fuel on the fire. He announces a 25% tariff on all non-U.S. made cars.
Is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%. And basically, as you know, and as you've been saying, not reporting as accurately as it should be reported because it's a massive story. Business is coming back to the United States so that they don't have to pay tariffs.
So would you like to Can I ask you about tariffs, Mr. President? On the car tariffs, how do you ensure that a car coming into the country is fully built? Could an automaker in Germany say, leave the tires off a car?
Yeah, we're going to have very strong policing, and it's pretty easy to do. If parts are made in America and a car isn't, those parts are not going to be taxed or tariffed.
These tariffs are,
Say it?
do these auto tariffs go into effect today or on April 2nd?
They go into effect on April 2nd. We're signing today. It goes into effect April 2nd. We start collecting on April 3rd.
Will those be immediately effective April 2nd on all countries, or will you focus on the worst offenders?
No, we're going to make it all countries, and we're going to make it very lenient. I think people are going to be very surprised. It'll be, in many cases, less than the tariff that they've been charging us for decades.
The blow to Germany, $35 billion in car exports per year, is monumental. BMW, Audi, and Mercedes-Benz may soon raise prices by $5,000 to $7,000 per car. German Chancellor Olaf Scholz condemned the move immediately. And for good reason, German automakers now face a brutal choice: eat the cost or lose U.S. market share. All of this adds up to a painful truth. These tariffs aren't just affecting global business. They're reshaping the economy. Consumers will pay more. Companies will relocate. Trade allies are drifting apart. And the geopolitical balance is shifting fast. What does this mean for the future? That's the trillion-dollar question. But one thing is certain: the world is watching and the cost is real.
Now in Germany, Europe's biggest economy, the Chancellor Olaf Scholz has called the new U.S. tariffs fundamentally wrong. For more on reaction from there, now let's bring in our Berlin correspondent, Nick Holdsworth. I mean, Nick, those are some strong words there from Olaf Scholz, but he did also say Europe was open to further talks. Germany kind of walking on both sides of the fence now.
Well, absolutely. The outgoing Trade Minister, Robert Habeck, has actually likened the impact of these tariffs to the kind of impact that the Russian launch of the invasion of Ukraine had on Europe 3 years ago, saying that Germany really had to look at what it could do to limit the damage from this, and also what it could do to talk with America. I mean, there's an idea already afloat that the EU could discuss a free trade zone with America. That may be wishful thinking, but, you know, the argument is, look, we'll have zero tariffs on our goods going to the States, and you put zero tariffs on your goods coming to us, and it's a win-win for everything, for everyone. But that may not appeal to Donald Trump at the moment, who seems to see the world in zero-sum terms, that there are winners and losers in every deal, whereas actually the world economy is a lot more complex than that.
Germany's warning shot in the escalating global trade showdown. Germany doesn't see the latest tariff from the U.S. as merely an economic jab. It's viewed as a full-blown attack on the long-standing principles of fair global trade. Flagship brands like BMW, Audi, and Mercedes-Benz, deeply entrenched in the U.S. economy, now face a direct threat. Officials in Berlin have made it clear. If provoked further, Germany and the EU will hit back hard. Retaliatory measures are already on the table. The EU is reportedly considering up to 30% tariffs on American agricultural exports, including soybeans, corn, and beef, worth an estimated $12 billion annually. Tech giants like Apple, Google, and Amazon could face up to 20% tariffs, signaling a much larger storm brewing, a comprehensive trade war where the U.S. might struggle to avoid real economic fallout. But Germany is far from alone in its response. These rising tensions may feel like policy moves on paper, but their consequences are real and growing. Tourism, agriculture, defense, and diplomacy are now deeply entangled. In the Arctic, Canada isn't bluffing. It's making long-term moves, strategic investments that signal a shift away from dependency on the U.S. And globally, allies are watching. Europe is building defenses. Asia is rethinking supply chains, and Canada is leading by example. The question now isn't whether the world is changing. It's whether the U.S. is ready for the new world it's helped create.
Share your thoughts in the comments below, and don't forget to like and subscribe now.